Joining us right now is the House Budget Committee ranking member, Missouri Congressman Jason Smith, Red Apple Group Chairman and CEO, United Refining Company Chairman and CEO, Gristedes D'Agostino's Supermarkets Chairman and CEO, John Catsimatidis, former Treasury Department economist and George Mason University Mercatus Center senior fellow David Beckworth is here, and joining the conversation all morning long this morning is Dagan McDowell and Liz Peek. Great to see everybody this morning. We are waiting on this very important number. Markets are rallying going into it. John Catsimatidis, let me kick this off with you. Your thoughts on inflation today as you see it in the supermarkets?
Prices at the supermarket are at the highest they've ever been. The price of diesel fuel is still very high. So to get product delivered to the stores, it costs more. The Thanksgiving dinner costs the highest it's ever been. And what happens now, oil is down to the lowest it's been. So there's a lag factor. So we have to see at what portion of the lag factor we're at. With food prices still on the up roll, oil prices on the down roll, it's going to be interesting how the economists in Washington looking at it. And the Federal Reserve has to look forward sometimes versus looking backwards, and that's what they've been doing lately, is looking backwards. I think if they hold steady on it, I think inflation will come under control unless there's a problem in the world.
You know, John, one thing that's really compelling is the fact that, yeah, we're talking about the consumer price index, but within that index, there are things that are still skyrocketing, like the price of eggs, up 43% year over year. You know, compare that to something like a gain of 7%, which is what we're seeing year over year. But Jason Smith, this is one of those stories where policy really matters. How did we get here?
Absolutely, Maria. Policy matters. This inflation crisis that Joe Biden and one-party Democrat rule in Washington created is going to give every American a blue Christmas. That is for sure. The price of Christmas trees have gone up. The price for presents under those Christmas trees have gone up to put food on their table and clothes on their backs and gasoline in their car. Everything's costing more. The reason why we're here, Maria, is because one-party Democrat rule has spent more than $10 trillion. They've added more than $10 trillion of spending to government. They have paid able-bodied, healthy adults not to work, and they have put the government's boot on the neck of U.S. energy. Those three things right there is where it basically is resulting where we are in the inflation crisis today.
It's really important to make note of that because it's a situation where policy changed everything. And that's why we are facing 40-year high inflation. All right, Dagan, we're a minute and a half away from the number. What are you going to be focused on? What's most important, Dagan?
Just so you know how much it eases potentially the overall number month to month, and then, of course, the core number. Gasoline has fallen quite a bit. In the last month, the national average is down 53 cents a gallon to $3.24 a gallon. And then housing prices, particularly rents, that's really going to filter through in the coming months into 2023. New rents have already started softening. The biggest factor that will keep inflation elevated will be wages in the services sector, because that is such a large part of the cost in services. That will be important to watch.
Well, I'm really glad you mentioned rent because, Liz, that's been the essentials that are so expensive: food, fuel, and shelter.
Yeah, there's no question. Rent's about 30% of the CPI, and that has gone up incredibly fast. Thanks partly, by the way, to the Fed's bond buying program, the mortgage bond buying program that only ended, I think, in June, which was really insane. But I was talking to John Catsimatidis about wages, because Dagan's totally right. Going forward, there are a lot of goods where the prices are coming down. Wages, not so much. And he says we're about to see that really kick in.
Well, we'll have that momentarily. The November CPI is imminent right now. Estimates 0.3% month over month, 7.3% year over year. Right to Cheryl Casoni we go with the numbers. Cheryl.
All right, Maria, a few things here. Let's start with the month over month on the headline number coming in up 1%, 0.1%. The estimate was 0.3%, so that's a little bit weaker than economists' expectations. Also coming in a little weaker than expected on the headline number year over year, coming in at 7.1%. The expectation was 7.3%. As for core, month over month, coming in 0.2% month over month. And again, the estimate was 0.3% there. So that's actually a little bit weaker than expected. Going down to year over year core, and this is the number that the Fed really looks at, that came in at 6% on the nose, 6%. The expectation was for 6.1%. So all of these numbers are lighter than expected. Real earnings, all private workers, a gain of 0.2%. Last year, that was flat. You guys were just talking about wages. Wanted to throw that out for you. Again, real earnings, all private workers, a gain of 0.2%. Housing, a jump month to month of 4%. Food, overall, a jump of 0.5% month to month. As far as other things that are in here, I'm going to dive into the actual report. Now, it looks like we did see a little bit of fall in energy prices. Energy prices overall falling 1.6% month over month. And that's actually, we were expecting to see that, and we did. Let me go to the report and tell you what the government is saying about the biggest contributors here. Basically, they're saying the index for shelter, and this is once again what they're telling us for the month of November, and we heard this back in October as well, was shelter. The biggest contributor here to these monthly increases was shelter. However, we did see the offset for the number was the big decrease we saw in the energy indexes. The food index, they said, that was 0.5% month to month. Food at home rose 0.5%. That's what people are paying for the grocery store to cook. And then as far as gasoline, they did see decreases for gasoline, for nat gas, and for electricity. Let me go down to a couple more things, and I'll send it back to you guys for instant reaction. But I did want to give you used cars and trucks, because that came in. That fell. So prices for used cars and used trucks actually fell 2.9%, and we're down now year over year 3.3% for that. Apparel, a jump month to month of 0.2%, which is interesting because we'd seen apparel prices for the last 3 months actually falling. That jumped 0.2%. Medical care, a jump of 0.2% month over month. So again, those are kind of the biggest headlines I can see here. And as far as electricity and utilities, those also were down. So inflation is slowing, and these numbers are a little bit better than expected. And the Fed starts their meeting today, Maria, so we'll see what they have to say.
Better than expected, sparking massive moves in the market. The Dow Industrials had been up 900 when you just started talking. The Dow Industrials now up 760 points. Yields are plummeting. The 10-year yield now down in the double digits. Congressman Jason Smith, John Catsimatidis, David Beckworth, Dagan McDowell, Liz Peek, Cheryl Casoni, all with me this morning. David Beckworth, your reaction to these numbers?
Well, this is a promising development. It continues a trend we've seen past few months. We hope it continues. But within that report, there is an area we need to keep an eye on, at least for me, and that's the services area. It grew pretty rapidly last month. I believe it's 6.8%. And that's the hardest part, as you were just discussing. That's where wages bleed into the economy. That's the piece that's going to be hardest to turn around for the Fed. And I think, Jay Powell expressed at his last public event that he doesn't want to rest on his laurels. He wants to keep going, keep fighting. No uncertainty about that, even though there is uncertainty about where the prices may be going.
This is a very important point that you make. Liz, inflation has moved from goods to services, because during the pandemic, we were all buying goods, and that was sending, and with all of the spending out of Congress, it was sending prices higher. But then after the pandemic, people started taking trips. They wanted services, and inflation caught up to services. David mentions a great point on the services part of this. Your reaction?
No question. And I think that trend's going to continue. I'm a little surprised to that point that apparel prices went up, because they've been going down mainly because retailers got caught short. They didn't understand that consumer spending was going to be as strong as it's turned out to be. Their inventories were inadequate, so they restocked. And then, of course, people moved, as you say, from buying goods to going on trips, going out to eat, et cetera. So all that discounting showed up up in the last couple of months and lower apparel prices. I don't know what to make of the fact that they're up again, except maybe inventories are getting a little bit more back in balance, which would actually be good news for the industry.
I mean, there's still a lag effect with higher interest rates, Congressman Jason Smith, because so far we've seen a real impact from higher rates on things like housing, which is in recession right now, or autos. And we see from this report used car prices down again. But you're still talking about elevated levels. The CPI up 7.1% year over year. How do you stop this? How do you reverse this completely?
You know, Liz, I mean, Maria, sorry, I just was calculating that since Joe Biden's taken the oath of office, inflation's gone up 14.3%. That is almost 2 months' salary of every hardworking American. And that is who's feeling the pinch. That's who's struggling. The way that we stop this is to stop the reckless spending. And in 3 weeks from today, when Kevin McCarthy becomes Speaker of the House Republicans will be able to stop this out-of-control stimulus spending. We're looking at government not even being funded yet. Government funding was supposed to be September 30th. We're 3 days from a government shutdown this Friday because the House Democrats, the Senate Democrats, and the White House have spent all their time spending excess stimulus money. Inflation Reduction Act, the American Rescue Plan, they have not funded government to keep their lights on. That is what has led to the highest spike in prices in 40 years. That's why people are paying more to put food on their table, clothes on their backs, and gasoline in the car. And you know what, Maria? What we also need to do is to make sure able-bodied, healthy adults are working. We have to have work requirements for welfare programs. There are help wanted signs all over this country. Let's get able-bodied, healthy adults back to work, and then let's take the government boot off of U.S. energy and allow energy independence. That will free up this economy and help Americans.
You make so many great points. John Catsimatidis, you feel it firsthand in terms of this energy policy. Talk to us about the impact of this energy policy on your business and what that has done to inflation.
Well, it's the primary cause of inflation, Maria. I mean, when energy prices had doubled, and that caused everything else to increase. The transportation costs for food, the price of heating oil for buildings, rents at an all-time high right now, because we're also in the real estate business. So my advice to Jay Powell is give it a pause. Don't create another problem in the real estate industry nationwide by continuing to raise interest rates. If we give it a pause and let things, how did the British say it? Let things sort themselves out. And if oil prices stay in the low 70s like I originally predicted, then things just go away by themselves. But if he keeps pushing interest rates, you know what happens? We'll create another problem in the real estate industry.
You're speaking the market's language, Dagan. That's exactly what markets have been hoping for, a bit of a pause. That's why we saw a 500-point rally yesterday, and we're looking at a 600-point rally at the open this morning, Dagan.
Right. The damage has been done in a lot of ways that you've already seen the bubble burst in assets like crypto and in the kind of newfangled Cathie Wood growth stocks. But you really haven't seen the air come out of housing prices. Housing is kind of apoplectic, so it's frozen. But you have not seen home prices come down because you don't see a lot of new supply coming onto the market. People are not putting homes up for sale, apartments up for sale. That's going to happen in the new year, potentially rents coming down. That will help lower inflation. But this week, you're going to see the Fed funds rate by the Federal Reserve get taken to 4.5%. So even Nick Timrose writing today, how long should Powell keep raising interest rates? Fed officials are divided. So you are seeing a bifurcation within the open market committee. So at 4.5% and core inflation based on the print today is at 6%. They will surely take a pause at 5%. They've only got, after this week, about half of a percentage point left to go. And maybe they just get it done with at the first meeting in the new year and then just stop there. And Liz and Peek and I were talking about this, and I was having a conversation over the weekend as well with an investor saying, maybe it's they just tolerate higher inflation. Maybe they just sit back and say, we're going to, not try to bring inflation down to, like, say it's going to be 3% or 4%. And just wait there because they don't want to crater the economy. But if you listen to a Stephanie Pomboy, the damage has been done. Yeah. In terms of the softening, or not softening, but we're expecting, many people, a very deep recession in the new year.
Cheryl, you've got more.
Well, I was digging into some of the components of the report while you guys were talking, and a couple of things I want to point out here. Dagan was talking about rents and shelter. The shelter number, that is still up 7.1% year over year for shelter. That includes rents for primary residences as well as just the overall shelter component. Fuel oil still year over year, guys, is up 65.7%. That means that as we are now in winter, that Americans are paying more than 65% higher fuel oil bills this year versus last year. Heating oil, a couple of other things here. Airfares, year over year, they dropped 0.3%, 3%, month to month, but airline fares compared to last year at this time are still up 36%. So there's still some very, very troubling pieces in the report. And I know you always look at the egg and the poultry and all of that. And overall, that is still up about 7% year over year if you combine meat, poultry, fish, and eggs. So, it's these numbers may be, not as hot as we expected today, but we're still seeing a lot of pressure on the American family in so many important parts of what they are spending on.
Yeah, I mean, look, you're seeing some things come in and other things stubbornly high. David Beckworth, why is it that food has been so hard to move? I mean, look at eggs up 49% year over year in this report. It was 43% in the last report. So you still have pressure on things like eggs, on meat, on seafood, as Cheryl was just saying. This is one of the last men standing, if you will, in terms of food and its inability to actually have real movement month over month. Why is that?
Well, it's unfortunate for sure, because that's, where the rubber meets the road. You got to feed yourself, feed your family. I am hopeful, though, that it will come down. If you look at the goods side of the CPI, look at the goods portion, we've already seen some downward pressure. You mentioned autos. Goods, capitalistic market brings it to bear. They respond. Services is the harder component, as I mentioned earlier. And if I can quickly go back to the shelter, I would also note there that may be overstating things a bit because of the owner's equivalent rent, which includes existing leases and current ones. If you look at market prices, like from Zillow, rent is actually following pretty steeply. So there's some hope there, and hopefully there will be promising developments in food going forward, because as a part of the bundle of goods, that tends to drop the fastest.
It's a good point. I also want to get your take on rates, David, because look at the 10-year right now. You're talking about the yield on the 10-year now dropping below 3.5%. We went all the way up to 4.5% at the peak. And of course, we know that the Fed is continuing to raise rates. Is this, does this jive with what you're expecting? The 10-year yield down almost 15 basis points right now.
Yes, and I base it off of the inverted yield curve. I mean, the market's been expecting something like this for some time. I as well, that the Fed has been tightening very aggressively, as we've mentioned. We'll be over 4% by the time this year is up. That's the most rapid increase since the early 80s. Of course, we've had the most inflation since the early 80s as well. But the lag effect, I think the Fed is focused on the service part of the index, which is important. But it's also important to note it tends to lag the rest of the economy. As your other guest mentioned, the Fed may be looking in the rearview mirror as it guides rates, and it may, hit a bump in the road and not see it coming, and that would be the recession. So I do worry the Fed isn't as forward-looking as it could be, and that, I think, is what the market is telling us to the 10-year yield today.
Liz.
Well, I think one of the X factors here, and something that should be really watched going forward, is energy prices. In November, we had a really sharp sell-off in oil and also in gasoline, and that's reversing itself now on expectations that China may begin to grow again. I mean, China has been a big factor in swaying energy markets, and it's, you know, who knows whether, in fact, China's rebound is going to be significant, but that's why oil prices are starting to move up again. And I want to go back to wages, because underneath all of this data, the one thing that persists and will persist is increased wage demands. We're seeing it in union negotiations. Again, I asked John Catsimatidis what he thought his workers were going to be asking for. The truth is, we haven't yet seen the roll-through of wage demands coming out of unions in reaction to inflation over the last year. The reason we have a rail worker problem is they weren't happy with what was considered a pretty generous settlement. So going forward, everybody wants more money, Maria, to deal with the inflation they've already experienced. That is what the Fed is going to struggle with next year.
Yeah, and they should, because Jason Smith, when you take a look at wage growth versus inflation growth, you're still looking at people having an inability to actually feel that raise if they got one, because wages are up 5% or so, but inflation is up 7.1% now in this new reading. Congressman, how much of the COVID relief package has been spent? I know that we've talked a lot about some of the money being allocated right now, and it still hasn't been spent. You also have certain states still giving out inflation checks, quote unquote, inflation checks.
Exactly, Maria. There's still hundreds of billions of dollars of COVID money that has not been sent, that have not been spent or processed. That's still in state and local political subdivisions coffers that are starting to still hit the environment. When you talk about real wages, as what was just mentioned, real wages for the 19th month today has declined under Joe Biden. It's now real wages have declined 3.8%. since Joe Biden's taken the oath of office. Just to put that in perspective, in the 105 months prior to Joe Biden being in office, real wages increased 102 out of those 105 months, but they have declined the last 19 months in his administration. It's because of his reckless economic policies. And I think, Maria, if you look at the reduction in used cars, that's the direct result of the skyrocketing interest rates. We have seen the Fed increase interest rates 6 times, the fastest increase in 40 years. In fact, the combination over the last 15 years combined. That's why people's purchasing less cars, less used cars, and that's why the prices are going down. You're going to see that in homes very shortly.
I mean, we don't have an energy policy that is constructive for the oil companies. We know that, John Catsimatidis, and it has been the energy policy that is underlying some of this stress on the part of families across America. Look, right now, you've got oil prices above where they were when Joe Biden started selling oil from the strategic reserve.
Well, if what could happen is if Joe Biden opened up North America, my next prediction would be $55 a barrel. And it could happen. And my advice to Jay Powell would be give it a pause. Let things sort themselves out instead of creating a new problem in the rest of the industries.
Well, look, we'll see. Maybe that's what they're thinking, Dagan. That's what the market has been speculating. We're up big since September 30th in stocks because investors are, suggesting and betting that this tightening phase is coming to an end soon. How many people have we spoken with that think that the Fed's going to start cutting rates at the end of next year?
I think a lot of those people are still. They haven't let go of that euphoria and the mania that took hold during the loose money days during the pandemic. That's very hard to shake. But to the congressman's point, that short-term interest rates, by the time that they're at 4.5% on Wednesday, that's the highest in 15 years. And they've gone up the fastest in 40 years. To repeat what the congressman was saying, that is a shock to the financial system. And the people who are getting shocked the most and the hardest are working men and women. So the burden was at first the inflation juiced by the Federal Reserve and the reckless spending coming out of the Biden White House. So they were taking on debt when interest rates were low to try and keep up with the inflation. And then the Fed starts hiking interest rates all of a sudden to 4.5%. And now their credit card bills are skyrocketing, and it's costing them more to go out and buy a new vehicle or lease a new vehicle. And that burden is going up. And so they're the ones who have, pardon my language, have completely gotten screwed in all this. The Federal Reserve's job has been made that much harder because Biden and company won't stop sending out stimulus. Don't forget that they have continued the moratorium on making student loan payments through at least the middle of next year. That is inflationary. It is a stimulus for rich people. And because interest is not accruing on that debt, the taxpayers are paying that, and that burden is being borne by people, again, who can't afford it.
Yeah. So what do we do now, Congressman Smith? I mean, we're looking at inflation having come off of the highs. Are we supposed to say, oh, well, inflation has peaked, so let's get back to the spending and the reckless approach to this economy? You know, Joe Biden just approved, what, 24% increase in wages for the rail workers. He wants this moratorium to continue on the student loan. He wants to push through that policy, which already has been deemed unconstitutional. So what happens now? You just said you and your colleagues are negotiating a year-end spending. How much more spending are we going to see before the end of the year?
Maria, 3 weeks from today, Kevin McCarthy will become Speaker of the House. We need to pass a continued resolution until the Republicans can control the House of Representatives so we can get our fiscal house in order. We do not need a huge omnibus trillions of dollars spending bill. We need to pass a continued resolution so when the House Republicans take control in 3 weeks that we can set our priorities for American people, and that's to get this reckless spending under control. And that is an absolute must. We cannot agree to this huge year-long spending bill.
Okay, but the Democrats are still in control. Are you going to be able to do that?
We can do that with partnership from the Senate because they have to have 60 votes. We need Republican senators to join with us and to join with Leader McCarthy to make sure that let us do a funding bill whenever Republicans control the House of Representatives. We'll be at a much better negotiating place. We got to do it for the American people. The American people are struggling to put food on their table, clothes on their backs, and gasoline in their cars. These numbers that came out today, Maria, those are just numbers. But what people are facing is the fact that almost 1/3 of Americans can't even afford a $400 emergency coming up by having $400 in their savings account. They're struggling. Yeah. The last thing they want is Washington to continue to spend trillions of more dollars to fuel this inflation fire.
Well, we were talking about a very different situation during the Trump years, Liz, because if I remember correctly, you had a tax cut plan out of the Trump administration and signed and approved by Congress that actually had the lowest earners seeing the biggest increases in their wages. That's back in 2017.
Yeah, that's a fond memory, isn't it, Maria? I mean, the truth is the economy was in great shape at that point. And by the way, part of it was because we had a real pro-growth philosophy in the White House and policies to carry that out. When was the last time any Democrat talked about growing the economy? That's just not their strongest suit at all. Maria, I wanted just to point out that we have had the biggest tightening, not just in terms of interest rates, but in terms of shrinkage of the Fed's balance sheet since 1940. There have been 3 periods since then where the Fed pulled in the money supply at the rate that it's happening now. And it takes a year, sometimes 2 years, to really show up. I don't think we know what the results of this big tightening cycle will have been. Those time periods have always been associated with a very good, deep recession. And I think we are going to pivot, all of us who watch this material, in the next several months, from watching inflation, watching the Fed, to watching job losses and watching earnings, because I don't think analysts are at all realistic about what the earnings are going to look like next year.
Yeah.
I think investors are going to have to start focusing on the impact of this Fed tightening, which we have not yet seen.
You're right. And the Journal writes about that this morning as the worry, the concern has moved from inflation to growth. So David Beckworth addressed that. What kind of growth would you expect for 2023? Do you think we'll be in recession in the first half and then a better performance second half? How do you see 23 playing out?
Well, I suspect it will be a mild recession if we have one. If we look at a number of other indicators, look at the labor market. This has always been the puzzle this year. It still is really strong. It's really robust. We have 10 million job openings, about 6 million unemployed. Last month, we had 263,000 jobs created, over 4 million jobs this year. If you look just at that, it's hard to see the economy slowing down. You had the Atlanta Fed president on who's talking about the Fed now showing pretty strong growth this fourth quarter. Third quarter, we had positive growth as well. So on one hand, we see some robust growth still occurring. On the other hand, we see real income, as was mentioned by the congressman, going down. So next year, it's definitely possible we go into recession, but a deep recession, I would be surprised. And if it does happen, it would be an incredible whiplash to the economy, because labor market is still doing relatively well. To get really steep job losses would be a drastic change. And it would be a shock. And I'm not sure it's going to happen that dramatically, but maybe it will.
But I want to point out, as Stephanie Pomboy has been sending me notes and emails and text messages during the last several jobs reports, that if you watch the household survey has showed massive job losses, and that is a pivotal report to watch at inflection points in the economy, when the overall employer survey has showed job gains. In the last 2 months, there's been a differential of 1 million jobs between losses in the household survey, which is small businesses, independent businesses, and the large employer survey. And so the employer survey is it's got a few months to catch up to the losses in jobs that you've seen in the household survey.
Yeah, it's a really important point to make. John Catsimatidis, we talked about oil, and your business is oil, but your business is also grocery. Put your grocery hat on for a second. With inflation coming off of the highs, are you expecting to cut prices at the grocery store? How much of a lag is that? Or do prices pretty much stay as is when I'm talking about getting up to the register?
It's the manufacturers that make that decision. We just make our normal markup. It's the manufacturers and the cost of delivery to the stores in the whole country. And right now we've seen zero. We're still seeing some price increases. So the prices at the grocery store will continue to rise for the next 30 days until January, and then we'll see what happens. I think it's time. The key word in the sentence today is it's time for the Fed to pause and sort things out, because the Fed is the one that's going to create the recession if there's a recession coming.
Congressman, after all of this bad policy that has resulted in bad outcomes, what are the odds that the Republicans take over in the new year, we go into recession, and the Democrats blame the GOP for getting us into recession?
Maria, you can count on it. Look at the inflation crisis. Joe Biden refused to even believe that inflation existed at the very beginning. Then he tried to blame it on COVID. Then he tried to blame it on Putin. And then they finally came across reality that inflation existed. That's exactly what they'll do here. 49% of small business owners say that we're in a recession right now. They're feeling it. And when you're talking about the rising cost of food, it's only going to get worse, because those farmers who I represent, they're paying 50% more for diesel, for wages, for the people working on their farms. It's going to get difficult.
Yeah, it all goes back to this failed energy policy for sure. Market is up on these better than expected numbers, up 759. Great conversation, everybody. Congressman Jason Smith, John Catsimatidis, David Beckworth, Dagan McDowell, Liz Peek, Cheryl Casoni. Thank you all. Thank you, everybody. We will see you again tomorrow. Varney & Company begins right after this.